Everyone, welcome back. Today we're doing a portfolio update. So I want to look at my portfolio once again. I did this update a few weeks ago. Now, what has changed since? The last time I did this update, my portfolio money rate of return was literally 160 or 163%. In the last couple of weeks alone, it's changed massively. So I'm looking at the app right now, free trade account. Last night when I checked it, it was 277%. I'm checking it right now and it's 322%. That's the worth of my decision. That's the value of my decision. That's my decision is my money, and my money rate of return is 322%. How much have my investment actually generated? 221%. This is absolutely incredible. This is since last year, 2022, December the 26th. And this was recently updated on the 24th of December. So it could actually be more because when the market reopens, we're going to find out if it's more or if it's less. But that's remarkable, 322%. Now, I did change my strategy quite a lot. Why did I change my strategy? Because my strategy, I was buying high and then I was buying on levels. That's still my strategy. But now, if I do buy high, I'm buying so much less. I'm putting so much less capital at risk. Originally, when I buy high, I'd invest like £500, £200, £400. And when the price goes down, I'll keep on investing, but I'll be investing like £100 or £120 or £150. I'd invest less when the price is going down. I've completely flipped my strategy. I invest less when the price is high and more when the price goes down. See, my strategy before, I was investing more when the price was high and less as the price goes down. I've completely flipped that strategy. It's done remarkably well for me. And I'm okay with sharing, but let me just say, this is not financial advice. This is just my opinion. But I want to take a look at a few different companies in my portfolio, such as CleanSpark, Watches of Switzerland, Blink Charging, Rivian, Rolls-Royce. The first one that we want to start with really is probably Watches of Switzerland. And then we'll do Rolls-Royce. And then I can probably look at the other companies like the CleanSpark company, the Blink Charging company, and Rivian. But let's start with Watches of Switzerland. So far, I've made 16.8% on that investment. And it was a tiny position. Like I said, I invested very small amount. But the incredible thing, if you look at CleanSpark, I've made 165% on that investment. And that's because I invested less when it's high and more when it goes down. So once again, the strategy works. It's improved. My strategy previously would make a good return, a really good return. But now my strategy now is making incredible return. I've improved the strategy, and that's what we're trying to do. Improve your strategy. Improve my strategy, sorry. So my strategy before was good. This strategy is great. And I'm looking at improving this strategy to make it incredible. How can we improve the strategy that's already returning over 200%? But hey, I digest. So first company that we want to look at is Watches of Switzerland. When was this report generated? 7th of November 2023. Now we've got the CEO, Brian Duffer. He's actually made a lengthy statement. You can read into that if you'd like. I prefer not to at the moment. I've already read some of it and I'll read the rest later. We really want to just look at the performance. So Q2, fiscal year of 2024, that's from April 2023 till April 2024. Demands of luxury watches remain robust and continues to exceed supply, with consistent additions and conversions of client registrations of interest lists, and average selling prices continue to increase. Group pre-owned sales grew by plus 88% in constant currency versus previous year. Let's take a look at how much they've generated in the UK and European revenue of 214 million in line with previous years. Now, this is the information that I really want to get. The outlook. Fiscal year 2024 guidance of sales and profit remains unchanged based on our subsequent trading of improvements. Let's look at this really important part, the guidance, on an organic pre-IFRS 16 basis. This is fiscal year 2024 guidance, right? Revenue so far, 1.6 to 1.7 billion. This is an overall growth of 8 to 11% at a constant currency in line with fiscal year 2023. Total finance costs, 5 million. Increase reflects on the impact of acquisitions. So for capital expenses, it's 70 to 80 million. That's remarkable. You got to remember, for a company like this, They don't actually manufacture the watches. They just operate, they just sell. They're a retailer, but they don't actually manufacture these timepieces. So that's why the capital expenses is so low compared to the revenue. The overall revenue is in the billions, heading to 2 billion. And to be honest, in the next 2 to 3 years, we can cross 2 billion quite easily. That's if people continue to buy these expensive timepieces. And it doesn't look like that's going away anytime soon. I mean, we've been in a recession for a couple of years now, and people are still spending on luxury timepieces. But who is spending on these luxury timepieces? You got to remember, this is not Louis Vuitton, where the average person, the average consumer is buying the majority of products. No, no, no. These are luxury timepieces. The average consumer are not buying luxury timepieces. The middle class, the rich, and the wealthy buy these timepieces. And those are the people that we can count on. Their money keeps growing, so they keep spending. And that profits us because our company has grown up in value. So thank you. So that's just a brief look at Watches of Switzerland. Now, if you look back at this company, the fiscal year of 2023, they made 1.543 billion. That was remarkable. And of course, they're looking to increase this from 8 to 11%. So if they continue to increase it on average from 8 to 11%, for the next couple of years, we're looking at breaking 2 billion. That's in revenue. Now, here's something that a lot of people don't pay attention to. The return on capital employed. That's how much are your employees benefiting the company? It turns out for this company, it's quite a lot, 27.9%. That's remarkable. And you look at the longevity. Do these employees actually stay with the company? You don't want to invest in employees if they don't stay with your brand. Companies that lose employees regularly are like Apple. These tech companies like Microsoft and Tesla, they lose employees on a 2 years basis. Companies like Watches of Switzerland, they like to hold those employees, especially the good ones, because they actually make more for the company. If you invest in these people while they're young, you pay them less because they have less experience, but you train them up. They reward your company a lot more than if you were to hire someone who already had an abundance of experience. They don't need any training. Their wages are going to be extremely expensive. So these companies, they try to operate on a basis that, okay, we want to hire young. We want to invest in them, and hopefully they reinvest back in us by staying with us for a long time. We increase their wages at the minimum, sometimes a little bit more if they're deserving of it. But as a company, companies function like this because they get great return on capital employed. Free cash flow. This is something that investors thrive off. Investors really love free cash flow. Without it, investors don't want to know your company. 146 million. This is fiscal year of 2023, by the way. We're looking to increase that as well in this year. Now, once again, this is the fiscal year of 2023, but it is important to break it down even more. Let's look at the growth that this company has generated since 2016, the fiscal year of 2016. In growth in sales, they're doing roughly around 456 million. That's in pounds. As you can see, for 2023, it's risen by almost 3 times more. In fact, it is 3 times more. That's remarkable. That's over 238% in sales growth. Let's look at the growth in adjusted earnings before interest tax. That's what they call the EBIT. That's 807%. You got to realize in 2016 fiscal year, they were generating 18 million. In 2017, 34 million. As you can see now, this company is generating 165 million, and that's in earnings before interest tax. So why am I highlighting these things like earning before interest tax? Why would I highlight the employees' rate of return? Because these are important for companies that do well. You look at companies that do well, they always have these few characteristics. They always have an edge in the market. And an edge in the market is really important. Some would call it a monopoly. That's why investors like Warren Buffett, they love investing in companies they call monopolies. But they don't really like to say monopoly. What they use instead is just by calling it a moat. It's what happens when you have an advantage in the market. Starbucks has an advantage in coffee. In cafes, they really have that advantage. Apple has an advantage in the smartphone and technology world for laptops and tablets and AirPods and other accessories. Look at the European sales and the US sales. You can see US sales take up 42%. UK and Europe sales take up 58%. And these are some of their brands: Rolex, Patek Philippe, Audemars Piguet, Omega, Cartier, Tag Heuer, Breitling, and Tudor. These are some of the biggest brands in the luxury timepiece market. So to be honest, that's why I like to invest in Watches of Switzerland. I consider this company to be incredibly undervalued. You look at the fiscal year revenue for 2023 that stopped at April 2023, you realize that this company's in revenue generated more in revenue than their market cap. If you consider that for the fiscal year of 2024, they've already generated more than their market cap in this year alone in 2023 overall. That's remarkable. So let me know, are you keeping an eye on Watches of Switzerland? Like I said, it's not financial advice, just my opinion. But I hope you enjoyed this video. Thank you for watching. Leave a like, leave a comment, and I'll see you in the next one. Peace.